We alluded to this yesterday. The markets, once again, trading at all-time highs. I think they actually hit new highs today and sold off just a little bit, just a handful of basis points. So we're going to talk about that and valuation with our good friend and colleague, Professor Mark Guthner of Rutgers, today on Office Hours. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Office Hours on Open Interest. I'm really pleased to be joined by my good friend and colleague, co-author of The Options Edge with me. I see that you've got the cover of the book on your Rutgers office wall back there, which is great. It's good to see you, my friend. It's been too long since we did one of these, and hopefully we've kind of identified a slot where we can get back to the routine of having these conversations.
Yeah, the Tuesday is going to work better. Your job is getting busy on Fridays. Sometimes mine is busy on Fridays, but I don't have any classes on Tuesdays, so this might be the time for us.
All right. Well, I hope that's true. I'm going to try to carve this out. You know, I think the timing, though, worked out really nicely because I had noticed that it doesn't seem like anything can slow this market down. Good news, bad news, everything seems to be good news, and that always gets me a little bit worried. We're going into what's generally thought of as being a seasonally strong time of the year, but we're also going into October and November. October and November are months that have higher average volatility than other months during the year. Largely that's the function of a couple strange years when we had really big pullbacks, big spikes in volatility, which have a disproportionate impact on the calculation of an average. Nevertheless, I think it's kind of interesting. And then I thought maybe once we get done talking a little bit about the market, maybe we can touch on things like Disney and Nexstar and Sinclair, because you have a media behemoth that is going in a certain direction, and then you have contractual agreements between these two smaller players, and I thought that would be an interesting topic. But why don't you share with us what your thoughts on valuation are? What are you telling your students, and what are the things that you're looking at?
Well, one of the things my students all do is we play a trading game, and throughout the semester, and there's a contest amongst all the students to see who can make the most money. So they essentially paper trade on a website called Investopedia, and
Oh, yeah.
which is a fun game, and the whole idea here is to introduce to students how difficult day trading is, because anything can happen in a day or two or whatever. New piece of news comes out, but over the long haul, if you buy something cheap, you should make money on it. So I'm trying to discourage the students from day trading. And what I like them to do is to do very poorly and get a bad grade, as opposed to do very poorly and lose 20 grand. So
Yeah, that's a little easier. That's a slightly easier low number to take
yeah.
than an
And
account balance.
and since it impacts their grade, they get that emotional response that you often get when you invest and something goes terribly wrong. And
So you're talking a lot about investor
yeah,
psychology then.
yeah, that I always say there's three enemies to investing. There's taxes, there's an inflation, and there's yourself.
If I may, just I'd like to interject one quick thing just to illustrate this point, and only because an article came out today that pertains to this. I don't know if we're able to pull it up on my screen. We have a fund. We have a lot of funds. So, in the YieldMax umbrella, there's probably about $19 billion
Yeah.
in actively managed options funds, as you know. This is one of them. This is Coney. It's the YieldMax Coin Overwriting Fund. Its inception was a little over 2 years ago, August of 2023.
Okay.
And the total returns are shown here in orange. And a fellow CFA charter holder of yours, who you may or may not know, his name is Jeffrey Tock. He's an analyst at Morningstar, and I've spoken with Jeff, and he seems like a thoughtful guy. He's done an analysis, and he actually published about it. And one of the interesting things that according to his work, he estimates that people who've invested in this fund, he believes, have lost money on balance. And that's really a curious thing, because if you take a look at this, this is a fund that since its inception, had you simply reinvested the dividends, is up 137%.
Mm-hmm.
If you hadn't reinvested the dividends, you'd be up 100%. Again, this is in 2 years. So 50% annualized return for 2 years. If you had put your money in it, and you should have doubled your money by
Okay.
now. If you had put your money and reinvested the dividends, you should have doubled your money and then made another 37%. But according to his work, because of trading psychology,
Oh,
people just deciding that they're going to, which is a curious thing to do for an actively managed fund. I don't know, because they're exchange traded. I suppose some people might treat them like a trading vehicle.
Yeah.
I guess. But I guess this kind of speaks to it. I mean, you have to try pretty hard to lose money in something that's gaining 50% a year in its lifetime, right? that's his performance in its lifetime.
wow.
So I think it speaks to, I think it kind of speaks to what you're talking about, that trading psychology can really hurt people if they don't recognize what it does.
Yeah, over the years, Fidelity has written some pieces on how their customer base often tries to chase returns. So a mutual fund has a great year, and then money comes in. Maybe it has another good year, so more money comes in, and then more money comes in, and then all of a sudden it has that inevitable bad year. And so they've got egads of money in the fund at the top and not so much at the bottom. And so they were saying that a typical fund that might make 10 or 12% a year, the actual experience of their customer base is more like 3 or 4 or 5%, because they keep rotating from what was hot last year. But just because something was hot last year doesn't mean it's going to be hot next year. And if there's any kind of mean reversion in the markets, you're systematically buying high and selling low, which is not a good thing.
So people should appropriately allocate, diversify, maybe rebalance slightly from time to time, but otherwise stay the course. That's the general academic view on this, right?
Yeah, and we teach the efficient market hypothesis here. I also teach some behavioral finance. But the efficient market hypothesis says you're not going to beat the market. Most fund managers do not. They might beat it for 1 or 2 or 3 years, but if you give them a 10-year time horizon, they probably underperform the market averages, principally because they have fees. So as an industry, if fees are an average, just let's say for a number, 1% of assets under management, they're over time going to underperform the broad market averages over a long period of time by 1%. And because there are no expenses in the indexes, nothing in there to buyers, bid offer spreads are not in there, commissions aren't in there. The effects of money moving in and out of a fund, which causes transaction costs, that's not in there. And so even if you put that aside, most funds do not.
Taxes.
Yeah, well, there's taxes too when they do trade. Most actively managed mutual funds have close to 100% turnover. So you're getting a lot of short-term capital gains that you've got to pay taxes on. So, it's best, when we started out in the business, there were very few mutual funds. They were actively managed, had high fees. I was talking about this in my investment analysis class just yesterday.
People like Peter Lynch,
Yeah.
most famously, arguably, of the Magellan Fund,
Yeah,
Fido.
but back in those days, the mutual funds charged 1.5% and sometimes 2% of assets under management. Very expensive. And now, you can go buy the S&P 500. You're essentially paying 0 or 1 or 2 basis points. But with Spider's SPY or Vanguard's product, what is it, VNO or NVO, or I don't remember their
You
ticker.
have IVV, I think there's VOO, and then you have SPY. SPY is, I think, 3 basis points, and I
Yeah.
think IVV and
So
I should double check
so
that
it's
because one of those is the
essentially
equal
zero.
weight or
So
value.
yeah,
Let's see.
it's essentially zero. And so it makes a lot of sense. I tell my students that, listen, you're going to get out of school. There's going to be temptations to pick stocks and stuff. And I would suggest you take about 2/3 of your money and you put it in index funds. And then you have about a third of your money and you have that for your stock picking endeavors, if that's what you want to
Or
do.
options.
Or
I'll
options,
just
yeah.
hold my hand up and say options.
Options, your little option
Since
strategies. That's right. So your active money. So 2/3 passive, 1/3 active. Um, and as long as we're kind of in this long secular bull market, you're going to make money over time. And if you actually learn that you have some stock picking skills, maybe you want to change that. But that's something that takes years to develop. That I remember when I was teaching investment analysis 3, 4 years ago, and the kids had to pick a company and do an analysis on it. They were picking the marijuana stocks that had like 20 or 30 million dollars a year in revenue and a market cap of 18 billion dollars, and
Mhm.
and they were defending a buy decision, on the stock. So um,
Let's try to defend a buy decision on the market overall. I think you have some interesting charts
yeah,
for us. I'd kind of like to see them because I think it's one thing to just say, okay, the market price has reached an all-time high, but we really need to think about it a little bit more
yeah.
than
So
before making a judgment.
yeah, so one of the things that has me concerned. Now, here's a picture of the S&P 500. It's at all-time highs. This is the big run after the great financial crisis. So if you held the course and you just stayed in the market, you made up your losses in the great financial crisis and made a pile of money to boot. And prices being at all-time highs, sometimes you get this reaction that maybe prices are getting too high because the prices aren't sort of cycling up and down and kind of washing out the weak hands and so on. You kind of get this big strong rally. That is not what bothers me. It's sort of the emotional reaction to these charts. So here we have the S&P 500. Let's flip to the next chart. That's the triple Q. So that's the Nasdaq 100, telling the same story. Oddly, it looks less volatile,
Yeah.
which not what one would normally think of. And if we go to the next chart, we have gold here, and
Hmm.
it's sort of up at its all-time highs. And then finally, let's look at Bitcoin to roll that in. Since I teach a digital asset classes, I keep track of what's going on here. And everything is at its all-time high, and everything is just starting to feel too easy. That actually you don't even need to do any work. Just go buy the market and then go play golf, and you're going to make 15% a year or whatever. And that's the part that gets me nervous when I see charts like this. That even if prices are not, there's still good value in the market. Um, and I'm going to argue in a second here that there's not. But even if there was, um, it's not. These charts wouldn't bother me. But it's the emotional reaction to it that it's all looking really easy. You buy and hold. Every dip is getting bought aggressively. So that works until it doesn't. So let's flip to the next chart. And this is the essentially a valuation index. And it's taking a bunch of valuation metrics, a big mashup of trailing PE, forward PE, the Cape PE, which is you take 10 years of earnings and then divide it by 10 and divide it by the current price of the S&P 500. Um, Price to book. Now, I would like to find this chart without price to book because I'm not a fan of book value of valuing anything other than bank stocks. Bank stocks, the assets turn over very fast. So book value and market value, there's a pretty good relationship there, but there's not a good relationship between book value and market value for a lot of things. One of the classes I talk about in my investment analysis classes is Home Depot. Home Depot's got a market cap of about $400 or $500 billion, and yet it's got a book value pretty close to zero. And so that's a perfect example of how book values can represent a problem and not really good for valuation. One thing that always makes me nervous, what is book value? It's the accumulation of all the effects of all the transactions that company has participated in since it was started out, right? And then you're comparing that to what you think is going to happen to the company in the future years. That's what the market price of an asset is worth. Accounting is backward looking, finance is forward looking. So when we try to value a stock, it's okay, what kind of stream of cash flows am I going to be able to extract from this business over its useful life? And then we do some kind of present value analysis and get a price for the stock. That's an entirely different exercise than the accounting that took place to get up to that point in time. So book value is not a favorite of mine, and it also gives me a little bit of pause even about using PE ratios because PE ratios are very tied to growth. Fast growth companies have high PE ratios. And then the big old mature companies, which we like to call value investing or whatever, has low PE ratios because they're not going to grow very fast. you know. But in any event, let's move on from that. And then we've got enterprise.
Doesn't that also, just to touch on the earnings
Let's go.
issue,
Let's go
just
back.
very
Let me
quickly.
finish that chart.
Okay.
So we've got also have enterprise value to EBITDA. Tobin's Q, the Q ratio, that's essentially an analysis that says what would it cost to rebuild all the companies in the S&P 500. Compare that to the price of the stocks now. So you have to go rebuild the factories, repurchase the intellectual property, all that kind of stuff. And so we take that market cap and then you divide it all by GDP. So you normalize it for the size of the economy. And here we are. We're up here at a place where we visited it in 1929 before the Great Crash, 1988, and then 1999. So we're back by these measures at all-time highs, and it's never continued on. Now, you can never say never that, this bull market may just power on. But this is telling you that if past is prologue, then you should start being a little bit more cautious. Maybe you want to start trading with options instead of just owning stocks outright. Maybe you want to hedge a little bit. Maybe you want to have a less risky portfolio and have a bigger allocation to short-term bonds. That's up to the investor, but high confidence is what makes the valuation get this high. So now we can run to the next chart. And it's just not stocks that's this way. This is home prices adjusted for inflation. So we can see that even if we take out the general level inflation, home prices are here at all-time highs, and they're even higher than we experienced during the just before the great financial crisis, when people were speculating on real estate hand over fist. And a little bit, this doesn't surprise me. I went to look at a bunch of houses when we were going through the lockdown because I was thinking about buying a house. and everything that I looked at was up sharply from the previous year, but people were bidding more than the asking price on the houses out here. So real estate is a problem. And of course, that's one of the reasons why Trump is kind of putting the arm on Powell, Chair Powell, because he wants lower interest rates to make housing more affordable. At least it not going to bring the price down, but at least bring your monthly payment down a little bit.
But will it though? Because I mean, really, the Fed. I mean, the only way for that to happen would be for the Fed to manipulate not just the front end of the curve, but the back. I mean, aren't mortgages more propelled by 10-year
Yeah.
rates? And the only way to manipulate that would be to aggressively, start using the Fed's balance sheet again to keep down the long end of the curve,
Yeah,
right?
by long-term bonds. So I don't think it will work. I actually think it'll work in the opposite direction. And it's interesting, ever since we've had the cut, the long-term rates have inched off a little bit. Yes, they had come
Unless
down
people use arms, I
came
guess.
it came down in anticipation, um, but I don't think it's a very good um, thing for them to do. To my mind, inflation's still a little bit too high, and I've got a chart on that here in a second. And then let's go to another chart. This is the number of Bitcoin treasury companies, and this is kind of tells you how companies are throwing caution to the wind. So MicroStrategy has had tremendous success raising the market cap of its company from about $1 billion to whatever it is now, $70 billion, $80 billion, by purchasing Bitcoin, putting it on its balance sheet, and riding the rising price of Bitcoin. A lot of people are starting to copy that. And now I can see from this chart, this was produced by I can't read the source now. I think it's stock treasuries dot yeah B yeah BT yeah BTC treasuries.net. And I look at that website a lot. There's a long list of companies now that actively state we are going to purchase Bitcoin with our excess cash. Some companies are, raising money to do the same. Tom Lee's involved with a new company where they're going to accumulate ETH because
Hmm.
he's a big believer that stable coins are going to ignite the demand for ETH because he thinks the ETH network is where transactions will be processed for stable coins. And of course, the more transactions there are, the more fees that people get who stake their ETH, and you get a virtuous cycle of rising prices. But this kind of tells me again another way of stating that people are getting complacent, that they're throwing caution to the wind and things like that. And how long can it go on? That's a big question. We might also ask beyond the psychology part, what's fueling it? What's allowing us to run up prices like this? And in the next chart, we see M2. This is a fairly broad measure of the money supply. It goes up when the government issues debt. It goes up when the Fed prints money. It goes up because it's counting bank deposits and things like that, as well as cash in circulation. And that's on the margin. And notice that it is about to break out above the 2022 high and continuing higher. So the financial system is creating a lot of credit, and some of that credit is flowing into asset prices. And so, to my way of thinking, that's going to keep price inflation from going down. We've had this conversation about this 2% target, where I have argued that the words say we're targeting or that the Federal Reserve is targeting a 2% inflation rate. But I argue that what they're really doing is making 2% a floor, because as the inflation rate comes down, the world screams and yells and said you got to cut rates, as if if the inflation rate went to 1%, the world would come to an end, which of course is not true. So I think the way I think about what's going on in the world, I'd say when they're targeting rates, just say to yourself, the Fed's going to try hard not to let it go below 2%. And as long as we have some inflation, that's always going to help asset prices.
I think by your work, Mark, you had done a very lengthy study on inflation, and I think your findings were for the United States, X periods of war, for as long as we were formally on the gold standard. So this was before there was any manipulation. For example, FDR's just unilateral decision that he was going to raise the price, I think, from $20 and change per ounce to 35, essentially devalue the dollar.
Yeah.
That X wars, that basically from the country's founding through the post-World War I era, there effectively wasn't inflation because although there was more money, although there was more credit, productivity improvements probably offset, and on balance, the cost of things in gold terms, whether it was a house or a suit or food, wasn't really rising for over a century. And it was only after we began playing with a little bit of the traditional monetary forms of debasement that governments have engaged in for millennia that inflation started to rear its head in ex-war periods, and then it sort of academia came around and said not only is that normal, that's a good thing.
Yeah, well, it even goes beyond that. So if just to make really clear what the numbers show is that from the founding of the country, the signing of the Constitution, to the creation of the Fed in 1913, the cumulative inflation rate was zero. So we did have two bouts of inflation. One was during the Civil War and the other during the War of 1812, because to prosecute those wars, the government had to borrow a lot of money. So that increases the supply of money and credit. Prices went up. But the government did something that our government no longer does, is after those wars, they ran surpluses and they paid off the debt. And as they did that, the price level came back down. And this is why I point at this idea, this Keynesian idea that falling prices is a disaster for the economy. It's not. We've lived through two of them after those two wars. With those, the 1800s were great years as we built the railroads and the massive expansion out west. So that's not really the problem. It's ever since we created the Fed, and I always am very amused when I hear people say, "Well, the Fed's here to fight inflation." No, they're the ones that throw gasoline on the fire to keep inflation alive. That could be a new one. It's like whip inflation now. Maybe we want to do a keep inflation alive, and that's what their job is. Their job is to print money and print credit. And so, since their creation, we've had an inflation rate of about 3.5% on average. So it's a remarkable.
Yeah, since the creation of the Fed, I think the dollar has lost nearly 99% of its value.
Yep, that's right. And I would like to remind people that a central bank is not a free market institution. You should pull out your copy of the Communist Manifesto, and the fifth plank is that the government should be in control of credit. So it is not a free market institution. It's an institution that is designed to help the government control, manipulate, whatever term you want to use, manage the economy. So
Hmm.
for those that believe that the economy needs managing. I, I don't. I think we all, with voluntary exchange, do quite nicely. Um, uh,
So what do we do here? I
so
guess.
anyway, well, my issue here is I kind of think that we might end up with this big blow off rally. So we see on the next chart that GDP is doing just fine. This comes from GDP now. This is the Atlanta Fed. The green line is their estimate of GDP in real time. So they're scraping the internet, measuring what's going on in the real economy, and they come up with real live forecasts. The blue line is the estimate of GDP by your traditional run of the mill economist, and the blue band, if you will, is just giving you some bounds around that. Somebody's got a higher, somebody else has a lower um, estimate of GDP. So, the Fed just cut interest rates, and I argue that they probably should not have. And the reason why is the economy is doing just fine. They're running the risk of creating a blow off in asset blow off, and while they're cutting, it's awfully hard not to stay in the market. So a lot of people will continue to ride that wave, and that's probably the right thing to do with one foot on the out, on the exit, so that if and when bonds start to behave badly because they start to sniff out higher rates of inflation, therefore the 10-year rate goes up, bringing up mortgage rates and things like that. Those things will be counterproductive. So that has me nervous, but at the same time, while it's going on, who was it? Was it Chuck Prince who said you got to dance while the music's still playing just before the great financial crisis? The CEO of
City,
Citibank.
right?
And that's kind of where we're at right now. The money printer's flowing, the
You
economy's
dance until the music stops, I think is what he
yeah.
said.
So the economy still is doing very nicely. Now, what is getting the Fed to think about maybe we should cut? Well, employment situation is slowing down, and it's hard to tell if that is because the economy itself is slowing down, or two, there's some kind of economic factors that businesses are responding to that says they're seeing some weakness in their particular sectors, so they put the kibosh on hiring new people. Or it could be that companies are learning how to use AI, and their employees are becoming more productive. I would argue that if that's the case, lowering interest rates is not going to help a company hire more people. Well, companies hire people when they see opportunity to expand their business. They don't
Hmm.
respond, at least in my view, that a quarter point rate change in short-term rates or even a 1% change in short-term rates doesn't give them, that's not the signal they're looking for. They're looking for actual real activity in their segment. And so that to me says that they're playing with fire here, that they got a hot economy, and um, they're trying to do something on the labor side, but they run the risk of having 3, 4, 5% inflation rates in the years ahead. Uh,
In support of what you're saying, I saw somebody. I regret that I can't remember who it was. It'll probably come to me in just a second. Making a comment about the health of the labor markets by saying that within the white collar community, there seems to be more persistent unemployment, and yet the local 7-Eleven can't find help. And of course, ChatGPT can't serve as a clerk at 7-Eleven.
yeah,
So, that's anecdotal, and hopefully I'll remember
but
who said that.
yeah, it's
But it does kind of speak to where the labor market weakness appears to be coming from.
Well, that's right. And the other thing that we should think about here is when they say they can't find people at the local 7-Eleven, they can't find them at the wage they're willing to pay.
Mm.
Really, what it's saying is that 7-Eleven needs to offer another dollar to an hour to attract the people and get them to stay and things like that. Why that's not happening, I don't know. Maybe it's because they can't pass through a little higher wage to and the cost of their products that they sell. Um, but when I hear stuff like that, it's, you know, price is what regulates supply and demand, you know, where those two meet. So if you're finding shortages, it's because prices are suppressed and things like that. But I think you're making a really good point. You know, your doctor's going to start using more AI, your lawyer's going to start using more AI. You think architects are going to start using a lot more. All these nice big service industries that traditionally offered, you know, high wages. Uh, Maybe
So
they're the
speaking of the
ones that are in
service
trouble.
industry, I happen, there's an In-N-Out near me, there's a McDonald's near me, there's a couple 7-Elevens near me, and I just happened to look it up. The starting clerk wages for 7-Elevens in my area is $23 an hour, 23.05
Okay.
to be exact. In-N-Out, $23 an hour. That's actually for Novato, which is just north of me.
Hmm.
Um, I'm assuming Mill Valley because we're a slightly more expensive town and a little closer to
Yeah.
Mill Valley is probably a little bit higher. McDonald's, $20.50 an hour,
Hmm.
which, by the way, doesn't really matter because California's AB 1228, which went into effect April 2024, mandates $20 per hour
Oh,
minimum
okay.
on the fast food side. So they're actually paying above the minimum wage as it is. I think they actually were at about that level. So that minimum wage thing, I think all it did was increase wages in those parts of the state that did not support them,
Yeah.
right? So, you know, in and around San Francisco, they were already paying those numbers.
Hmm.
But in, you know, probably more rural areas of California, you're a native Californian, you lived close to Los Angeles, but I'm sure in the Central Valley and things like that, the wages were probably considerably lower, and it brought those up. And I think there have actually been some closings that have resulted um, from that.
Yeah.
But
I've
you know,
read quite a few.
I think what it does is it speaks to the point you were making, which is that they can't find employees at the wages that, in this case, the law demands, that it's still economic for the business.
Yeah, that's right. So um, when I talk about corporate finance, I always and in the running of businesses, the challenge is a balance because a good business and good managers have to balance the interest of employees who want a higher wage, of their suppliers that want a higher price for their products, and then shareholders that want a higher rate of return on their investments, and their customers who want a lower price for the product and higher quality than the product that they have. So a good business has to take all those forces that are in conflict and balance them out someplace. And when government decides they're going to give more weight to one or the other, it can cause problems with businesses their ability to um, manage that balance.
Mm-hmm.
If they really wanted to help people, if the state of California really wanted to help people earn more money, they should get rid of the income tax on the first $20 an hour you make. But of course, um, that would never fly. So,
I looked at a recent pay stub of mine, and you know what is more just over 47% of in my standard paycheck is what is withheld.
Yeah,
So
yeah.
I'm getting 52 and a half cents on every dollar I make, and I'm rather hoping that I don't end up with a tax liability at the end of the year.
Uh,
Um, so
this is the only thing I didn't like about Milton Friedman, and he's the one that suggested the payroll to withhold taxes when they started to institute higher income taxes to pay for World War II. Um, People would think about differently about their income tax if every month they had to write a check to the government for whatever it is that they're taking out. It's they make the extraction of your paycheck less painful by simply taking it from you before you ever knew you made it.
hmm.
So
What's this next table you have for us here?
oh, this next table, this was just CPI because I wanted to remind people kind of that this was the recent CPI numbers that were reported. So for the month of August, the actual was up zero point 0.4. The forecast was going to be for zero point 0.3. And if you take zero point 0.4 and annualize it, then that's 4.8%. Simple annual. And then if we look at what had happened over the previous 12 months, it's 2.9%. So this was, I wanted to remind people we're not even near 2% yet. And yet the Fed is cutting rates. And so I have fears that we're going to have more inflation, not less. This is going to be bad for the bond market. And if it's bad for the bond market, and rates go up on the 10-year, the government is not going to be able to term out its debt because it's financing most of its debt these days with treasury bills, which was one of the goals of getting rates down as the federal government could, buy or sell 10, 20, and 30-year bonds and lock in lower rates. I don't think they're going to get the chance to do that. They run the risk that longer term rates rise, and so they're not going to get the benefit in the real estate market that they're hoping to get. So the numbers to me just don't add up, and that's why I wanted to talk about that. I think probably the worst thing to invest in right now is probably treasury bonds
Mm.
of the 20 and 30-year ilk.
So this brings up an interesting point because, and I was actually gonna ask you about this. It was just something I was thinking about, completely independent of what you might be talking about today. But it happens to tie to this. People who are watching almost certainly will remember that a couple things really started to fall apart in 2021 and beyond. As inflation really began to rear its head,
Mhm.
interest rates started to spike, particularly at the long end of the curve. 10 years had gotten down to what, like 60 basis points,
Yep.
maybe lower. I don't remember exactly what it was. And the long bond, of course, having much more duration, got annihilated. A lot of banks were taking in massive amounts of money in deposits during the pandemic,
Yep.
largely because of transfer
Yeah.
payments. So you had massive transfer payments, and they were then taking those assets. So now they have this liability, demand deposits, and they would use the proceeds of those deposits to buy fixed income assets or to make loans. I mean,
Yeah.
that's ostensibly that's what a bank's supposed to be doing, but in fact, depending on the rate of economic activity, maybe you're just buying financial assets, and then you stick those on your balance sheet. So now you have an asset. Maybe you put it in your HTM, your held to maturity book,
Yeah.
so that you don't you actually amortize those assets over time, and you don't actually mark them to market. Now, what happened, of course, is that as rates rose, bonds fell sharply in the case of long bonds. And for a lot of banks, like Silicon Valley Bank, like Signature Bank in New York, and some others, actually even Bank of America, which I can't remember what I read the duration on their portfolio was, but I want to say it was like 6 or 7, something in that neighborhood.
Yep.
I don't know. You may remember better than I do. Certainly, it was a lot more duration than some of their competitors, like J.P. Morgan had. And now you wouldn't necessarily see these losses reflected in their quarterly earnings releases because, like I said, many of those losses were not only unrealized, but they were unrecognized because they were in the HTM book, which is essentially an accounting. Dare I call it a sleight of hand? But
Yeah.
it's a mechanism. So, and I understand its intent. It's so that people don't get all panicky about the stability of financial institutions. And in any case, the Fed was permitting banks to use all of the assets that they held in those portfolios as collateral against loans that they could take from the Fed at the window, basically at par value, right? So even if you had a $100,000 loan out that if you marked it to market was now 70, they could actually present that as collateral to the Federal Reserve,
Yep.
and its loan to value is its loan to par or 100,000. The problem, of course, is that if you're loaning money at 150 basis points and you're borrowing it at 450 basis points, that's not good business.
Yeah.
The reason I bring this up, though, was because of something more recent. So Truist, which is one of the maybe better known regional banks, was founded as a result of a merger of a couple others recently. So they have been they recognized some losses. It seemed to me like they had recognized some losses voluntarily on their held to maturity book.
Oh, interesting.
$6.8 billion they took in the midpoint of last year. I am curious whether you think so. Financials have been doing really, really well lately. Now, on a price to earnings basis, not probably a good way to think about valuing them, but on a price to earnings basis, they look cheap.
Yep.
And one thing I heard said at a conference I attended recently, so a week or so ago, I was in Las Vegas. I guess it was 2 weeks ago. I was in Las Vegas, and I was at the Hood Summit, which is the annual summit held by Robinhood. Very well attended, by the way. It's
Yeah.
kind of it's a big frenzy over there. One of the things that one of the presenters said is, basically that, you don't want to sell equities when financials are rallying. Basically, if financials are rallying, it's signaling a couple of things. It's signaling that you're in a risk-on environment, that the economy is expanding, and I don't know. They did not say this, but I wondered whether this was part of what she meant. There was a woman that was saying it. That it also suggests that you're not going to get major mid and long-term rate disruptions, and particularly spikes, because that's when financial institutions tend to get into distress, because suddenly the overnight rates that you pay. Now, of course, people are always talking about these net income margins. This back end of the curve goes higher, the short end goes lower, and banks make more money because they borrow short and lend long.
Yep.
The thing is, though, that they have these enormous balance sheets, and this ignores the fact that if rates on the long end rise, as you pointed out, they have, after briefly dipping, they have gone up. They have these enormous balance sheets. This is not helping the assets on those balance sheets,
Right.
whether it's in their held to maturity bucket or in their available for sale bucket. By the way, for those who are following along at home, the available for sale are those securities that banks generally do mark to market versus the amortized ones in the HTM books, which they don't. What are your thoughts on that?
Well, the regulations, as you mentioned, are designed to help sort of smooth out earnings so that you don't get little
A run on the bank.
up with earnings, down with earnings, because interest rates are moving around a lot. And if a bank is intending to make buy a 10-year treasury and hold it to maturity, why not? The problem is when rates move a lot and people don't have the risk management. So you can take all your, in a mark-to-market book, you take all your loss right now. But when you take it on a held to maturity, you're essentially taking your loss spread out over 10 years. So as you mentioned, you've got an asset that's making you 50 or basis points or 1% a year, something in that range. You're financing it now with deposits that are costing you 3, 4, and 5%. And so you die a death of a thousand cuts. That's why those banks got into trouble and they had to go borrow money from the Fed because I think it was Peter Thiel who came out and told his friends in Silicon Valley that Silicon Valley Bank was in trouble because they had taken all the deposits and put it into 10-year treasuries, which were now trading at 60 cents on the dollar. So so people started transferring their money out. Silicon Valley Bank's it had a lot of assets, but not that many customers because their customer base were all millionaires. So it didn't take much.
Centimillionaires in many
Yeah,
cases. I think they had multiple deposits that were in the nine-figure
yeah.
plus
So
range.
they
Yeah.
just pull out their app and shoot the money over to Bank of America or J.P. Morgan, someplace you know is cheap as is going to stand and strong, and you save yourself. But it causes a demand for capital, and that was going on so long that okay, now I've got all these mark-to-market securities. Okay, I'm just going to be selling those. Now I run out of that. This is the real reason why the Fed was created was to be a lender of last resort. So that you could take your assets that are illiquid. A bank could take their assets that are illiquid. The Fed would take those assets, give them cash. They could deal with their short-term liquidity problems. After they got back on their feet, they would maybe bring in new deposits. They could go buy their assets back, and everything is hunky dory. That just doesn't work when the value of your assets went down. And banks are supposed to be riding floating to the extent that all their liabilities are floating, their assets should be floating. So it's like when I was at writing project finance loans at ANZ Bank, every bank was a LIBOR-based floating rate loan. So I might lend money for 15 years, but the bank was getting LIBOR plus some spread every 6 months. And so interest rates were never part of our analysis. We were always focused on will these projects generate enough free cash flow in order to repay the debts as they came due.
It was a credit problem, not a rate
Yeah, so
problem.
we focused 100% on rates. I mean, on credit, not rates. Um, and unfortunately, people that were running Silicon Valley Bank were not traditional bankers, and they didn't have any founding grounding in risk management. So, the mistakes were made, and they paid the price.
I mean, in Europe, it's much more common to have floating rate mortgages, is my understanding.
Yep.
And so I would assume that reduces that risk somewhat. However, I also understand that home prices relative to median incomes in Europe also have followed a trajectory not dissimilar to our own, such that housing has become unaffordably expensive in much of developed Europe.
In some places, yeah, most, it's very rare. The U.S. is unique in having Freddie Mac and Fannie Mae, that they buy fixed rate mortgages, they put a guarantee on them. So that pension funds and insurance companies, and to some extent mutual funds, these are investors with longer investment horizons. They feel okay for taking those, but the bank doesn't want them, and that's why they get rid of them. Banks are going to be much more likely to hold on to their floating rate mortgages. But even then, banks in the U.S. often want something that's that's guaranteed, has a third party guarantee. So they'll sell a floating rate mortgage to Fannie Mae and then buy it back as a guaranteed product. So they don't have to worry about they take something that has a something less than a AAA rating, and they get something with a AAA rating back. But that's very unique. They don't have that in Australia. And that I learned, I was a little surprised at that. Canada, my understanding is most mortgages are fixed for 5 years and then they float after that. Um, and I'm going to guess Europe operates much the same way. But it's that's not my. I never really involved in those markets. I don't know the details.
Yeah. So, I mean, we'll button up the broad market conversation and then touch very briefly on something I'd asked you about
Yeah,
early. I mean, your thinking here then is that people shouldn't just necessarily hit the sell it all button now, but they should definitely be have their finger hovering,
yeah,
covering the brake, as you say, and in when you're driving a car and you think that there might be some risk, you've got your foot over the brake.
right.
You haven't started to
Yeah,
hit it yet, but you're really ready, and you think it's based on valuation that people shouldn't feel uncomfortable covering the brake,
hmm
and maybe when there's any sign of trouble, what would be an appropriate sign of trouble? I know that for me, one of the things that I remember from, for example, the tech wreck, uh, and arguably we saw this also in the GFC, was that uh, volatility started to rise.
yeah,
Risk asset volatility started to rise before everything completely fell apart. That was the warning sign that cracks were beginning to emerge. And sometimes that volatility was both down and up. Like Cisco would gap down and then it would gap back up again
mhm,
on FOMO
right.
in the last throes of the tech bubble. So, what do you think would be a good sort of indicator for people to use to say, I'm gonna pair here, or I'm gonna at least maybe buy some protective puts or put spreads or something like
Yeah,
that?
I would be watching. Well, VIX and the MOVE index. VIX is implied volatility on stocks. MOVE is implied volatility on longer term bonds. I
Mm-hmm.
would also be watching just the 10-year bond rate. If that starts to go up in a substantial way, like, it really starts to move up, that is going to put a freeze essentially on
Oops.
the real estate market. And so things will likely get a lot worse there. But I would also watch the auctions as the government auctions securities. If some of the auctions don't go very well, that would start to be where they got to offer a higher rate to get their new securities sold. That's what I would be watching. The bond market, I think, is going to tell us where the equity markets are going to go.
Yeah, let's see when the next auction is. Actually, don't we have some concerns about a potential shutdown? Isn't
Yeah,
that one of the conversations that's currently going on?
yeah. The government
Uh,
shutdown never bothers me. Um,
mm-hmm.
I don't ever recall. I do recall that all the time. The debt ceiling limit. Oh, if we don't do that, the world's coming to an end. If the government doesn't pass a budget, the world's coming to an end. And that's been going on my entire career. And yet, I've never even seen much of a hiccup um, during
So
any of
today
these
is
time
the
periods.
23rd, and I just happen to be looking at government auctions right now. Um,
But
and the bid to cover was 2.5. Prior was 2.8.
hmm
The direct accepted percentage was 5.5, and the indirect accepted was 45.2. How would you and the high yield rate 4.01 versus 4.04? How should folks be thinking about these auctions? What is the number that they're kind of looking for? Is it a trend from one period to the next? Is there an absolute number that kind of represents a threshold
yeah,
where one might get a little bit concerned?
yeah. So the
Um,
government does its coupon refundings in February and August, those two coupon dates, and then May and November. So that's when
mhm.
the big refundings take place. They're doing treasury bills every week.
Mm-hmm.
Um, and but those are the big ones. Um, I would watch trend and is the is going into the auction. Let's say the 10 years at 4.1% or something like that going into the auction. And then to get it sold, it's got to go at 4.2 or 4.25%. Those are the kind of things that would really grab my attention. That they're finding it hard to find enough people
So
to
the one
buy.
that for people to keep an eye on would then be like the November 12th 10-year.
Yeah, yeah. That they're going to do a 2 year, they're going to do a 3 year, they're going to do a 5 year, a 7, 10,
I kind of
20,
feel
and a
like the
30 that
two.
month.
I feel like two and in. I
Yeah.
feel like that's rarely a super risky
No,
place
it's
to
not.
play.
It's when they start to really look
Um,
at the 7, 10, 20, and 30.
hmm
Yeah,
So that's going to be the 12th and 13th, really,
yeah,
of November, and there might be some anticipation of that because people talk.
yeah.
Um,
So, and then I've always kind of, as I thought back in my entire career, I always thought the market would react violently when the deficit hit $1 trillion. Then, of course, when it did hit $1 trillion, nobody cared. It was a big yawn. So
mhm.
that went on. And then I said, well, maybe I'd change my hat. Maybe it's when interest gets to be $1 trillion a year. And unfortunately, we've hit $1 trillion in interest, and everybody's yawning. Like that doesn't matter. So I just kind of feel like we're kind of in some weird times. That
Yeah.
everybody's. I think optimism is very high on average, and that's why asset prices are high. Most people who want a job have a job. Um, yes, there's weakness now in finding new jobs, and I know my students are going to have to work a little extra hard to find that first job upon graduation.
I saw a statistic. I don't know if this is consistent with what within the university you're seeing or hearing, but I I saw a statistic that said that back when you and I were getting out of high school, the unemployment rate for people with only a high school diploma was, I think, 2.5 times higher than it was for people who had a 4-year college degree,
Okay.
and that gap has actually, there is none anymore. There is no gap.
Hmm.
That the unemployment rate for people with a high school diploma is the same. Now, that doesn't necessarily mean that the job prospects are the same,
Yep.
because those that are employed with a 4-year college degree may have better jobs than those that do not.
Hmm.
Although, if I look at the trades where I live, I think it would be very difficult for somebody in a white collar job to hope to make what a tradesman would in this area
Right.
on an annual basis. And a tradesman has the opportunity, in theory,
Yep.
to one day operate their own business. And you can build wealth in your own business. There are periodically tax advantages to operating your own business. You still have tax liabilities, but you have more control over how and when they are affected, and the deployment of capital, reinvestment of capital, and things like that.
Yeah, and
Um,
it's very hard to export a tradesman's
mhm.
job.
Yeah, ChatGPT won't unclog the toilet
Oh, but it
if
will. Although it will help because you can look up online and ask for some. How can I? It has these parts in
for
it.
anybody who doesn't know how to use a plunger.
Yeah, it's like okay, it has these parts, and it could come back and tell you, well, these parts are prone to this kind of problem. So it might
Hmm
make them a little smarter, but it's not going to get rid of their job. Or I could see something
So
like that. You're trying to repair air conditioning system, things like that that can be more complicated. Maybe AI is going to help that, but it's not going to certainly not going to replace the person. That's for sure.
do you have time to, before we jump, because we've been going for about an hour now, to something completely unrelated,
Sure.
but I thought it was kind of interesting. Um, so, for those who are following along at home, and this story's been broadly covered, so I assume that people are aware of this. Late night talk show host Jimmy Kimmel, his show was suspended after, I think it was after pressure from a couple of the television station operators,
Yeah, syndicate syndicate buyers.
which had each of which had said that they were going to what's called preempt the show. So, and this is kind of interesting from a business point of view. Those two companies were Nexstar and Sinclair Television. And I had actually been looking at Sinclair Television independent of all of this because I was kind of wondering at what point do these businesses, so Sinclair is SBGI, if I remember correctly. Let's see if I did. And yes, it looks like that was correct. So you're dealing with $1 billion company, quite a lot of debt,
Mm-hmm.
on a relative basis, $4.1 billion. It does have, some free cash flow, but this is not a really, it's not a super high margin business. Nexstar, if memory serves, I think Nexstar, that's the scary chart, right? That's the 100-year NXST. There we are, Nexstar Media Group. That was the 100-year logarithmic chart for the S&P.
Yeah.
And I think one of these companies was thinking about merging. So Nexstar is the larger of the two, $6.2 billion market cap. Debt to equity is about 50-50 in this one. Considerably more free cash flow, especially relative to their debt level, because the other case, I think, what were we looking at? $130 million on $4.1 billion of debt. That does not feel like a whole lot of breathing room to me. And the reason I bring that up is because, folks are sitting, I've seen some report that television show, that the Jimmy Kimmel show was losing money, but because it had been losing share, but net of everything, all the sources of revenue that the company receives from the show, I've seen others report that actually, in fact, it is profitable. I don't know if that's true or not. I do know that when people are saying, oh, he makes $16 million a year, that's immaterial to Disney, which has revenues that are probably going to be north of $100 billion next year. My question actually is about Sinclair and Nexstar's, their position, because they are trying to navigate a tightrope. They have to. It's a regulated space, so unlike cable, unlike what we're doing, we can swear and do things up to and the boundary of whatever it is that YouTube will accept, but for free television broadcast, so using the frequencies that the FCC regulates, they have certain regulations about what can and cannot be said. And so they're trying to navigate this tightrope. Plus, they have their contractual obligations. One of these two companies, I think, just renewed a year ago. And basically, the gist of this is that the parent media company, in this case Disney ABC, creates content. And then these media companies contract with that business for a period of years to essentially to broadcast their feed. Mm-hmm. So their national feed is what the network wants shown, around the country. They can, from time to time, preempt that, which means if there is regularly scheduled national feed programming, they can elect not to do it. One of the reasons they might do it is maybe you have a local emergency. Right. Maybe there's very bad weather. There's a flooding, and it could, or there's some other regional story. There's a host of reasons. But what I'm wondering is, what your thoughts are with respect to both of these companies being able to, exercise their own discretion or judgment. I feel like if they try to preempt in perpetuity a given program, if it's I don't know if ABC considers it a major program or not. It's not like the Super Bowl, but whether they face significant legal liability from the parent, which in the case of Sinclair it can ill afford by my work. I mean, they're operating on a razor's edge here, by the look of things. And yet they're also facing potential pressure from, an FCC chairman who, from what I've seen, I forget his name. What is this? He's unhappy with the content. So let me see what his name is. Mm-hmm. I know he's Brendan Carr, exactly. Yeah. So his name is Brendan Carr. What are you thinking with respect to these businesses? And also, I mean, you're you're a credit guy, right? So you look at this balance sheet and you say, well, okay, so you got $1 billion in equity. It's a $4.5 billion enterprise value, which means it's got substantial $3.5 billion of net debt, and it has maybe $675 million in EBITDA for next year. I'm not sure if EBITDA is really even. I'd probably prefer to see EBIT,
Right.
because I assume that for a broadcast company that depreciation is a real expense.
Yeah.
It's not just some little fiction that you put down. What are your thoughts as you look at these businesses? Do you have
Well, what I would wonder is how long their contracts are for. Are they tied in to offer the programming for another 6 months or a year, or 3 years or 4 years? For them to switch is maybe they violate their contracts. Of course, you'd need to have visibility into the contracts to know that. But their problem in terms of distribution is they're getting local advertising. So what I had heard was that they're getting pushback from people saying, I don't want to advertise on that show anymore. The viewership is not high enough. Um, and and so what do they do?
2026, by the way.
Yeah, what do they do? That's a hard one. Maybe that's the risk that they take. Okay, I'm going to get this programming for 3 years. I think we can sell advertising against it, and and make a buck. And they're finding out maybe they can't do that anymore. But a lot of these late night shows are not that profitable. Jay Leno was very profitable, and the Tonight Show's
Johnny
with
Carson,
Johnny Carson
David
had a
Letterman.
formula. It worked, and it was all around entertainment. These other shows, they kind of target more of a narrower demographic. I get the feeling.
Mm-hmm.
So
I imagine that's to try to get a stickier audience. I mean, at the time of Johnny Carson, you turned maybe you had cable, but if you didn't, you turned on your television. You had literally a handful of stations that you could choose. So, you kind of had a locked up audience. And also, I think there was more of a habit back then about the way that people, how they enjoyed content. It was a much more structured and scheduled thing. You would have the local news would come on, the national news would come on, primetime would come on, late night news would come on, and late night television would come on. And some households almost certainly turned the television on, and it basically, during the week, and it basically ran from start to finish. I mean, my other question would be, of course, that if they wanted to preempt that content, that means they have to put something else. They're not going to just show a color bar.
Yeah.
So they're going to have to.
They have to have something else.
Instead of, not like in the old days, suddenly play the Star Spangled Banner and then turn the TV to snow.
Right.
And I mean, it's not going to be like that.
Yeah.
So that not only do they have the issue of trying to sell advertising, but they also have to go find content. This seems like a very difficult row to hoe. And so anyway, I didn't know that I had a conclusion necessarily on these companies, but I thought that, I know that everybody's caught up in the politics of it all. I'm a little bit more interested in the moment about the business of it all, because these are indebted businesses, Sinclair in particular.
Yeah.
And this is and this is also, I think investors should know that if I simply say that, look, this company's carrying a lot of debt, and empirically they are, right? So $1 billion market capitalization, $4.5 billion enterprise value, it's clear. But this also cuts both ways, right? Because if you have a lot of leverage and they turn things around, that leverage will translate to outsized gains for the equity. So it's not necessarily an indictment, although it's a risk, a very high risk, in my view. It's just something to think about. Maybe we'll bring it up on another issue, and maybe we can dig into it a little bit more. But I will say this: we've been going for an hour and 15 minutes. For anybody who stuck around and watched us, talk about these things, I hope you found that worthwhile. Like, subscribe, and do us a favor. Uh, put topics that interest you, because I think you can see by this that, Mark obviously does a lot of work on a lot of different topics, but if there's something that really interests you, and we see that there's some consensus about that, maybe those are topics that we can address in this kind of long form detail in our next office hours. And it sounds like Tuesday is going to be a good day for you. I think it's going to
It
be a
will
good
be,
day
yeah.
for me. So, for those watching who want to see another one, please tune in next week on Tuesday, which is when we intend to do the next one, assuming something big doesn't come up.
Okay.
Mark, thank you as always for joining, and thank you for your slides. I always find your thoughts really helpful and insightful. And to all of you watching,
Great.
thanks very much. We'll see you soon.
Thank you, Mike.